ZOMATO. This is one of the successful digital platform in delivering service eateries to consumers, between acting as a bridge between eateries and consumers. It has gone to public issue and got subscription successfully in the equity market, in the primary issue. Now, what is the position of ZOMATO share, ZOMATO equity in Indian equity market? ZOMATO should be more valuable. A 23% free fall in the ZOMATO price, company stock price in just 48 hours last week, made the comparison a fair comment in an inflation economy despite the changes in the prices of red vegetable. ZOMATO share price has reduced by 23% immediately after listing in the share market. It reduced by 23% in just 48 hours, so that there is a loss to investors who purchase in a public issue. A lodestar among homegrown unicorns that was the first to raise money from public markets last year is today unloved and underperforming. Now the ZOMATO is unloved and underperforming in the share market because it is losing its value, and also share price is down compared to the public issue price. Since its blockbuster listing last July 2021, when it leapfrogged 65% on listing day, ZOMATO is now the poorest performing in Indian consumer in internet stock, down 67.3% since the start of the year, having reduced rupees 71,300 crore in capital market capitalization. Because of reduction share price, the investors has lost to the extent of 71,300 crores who invested in ZOMATO share in ZOMATO. And also ZOMATO is facing another problems, adding to the operational woes, serious questions on conflict of interest, key personal churns right after listing, governance lapses, ESOP, employee stock option plan, largely to key managerial personnel, despite losses and some seemingly jubilant tantrums. Even retail shareholders should demand accountability. Now, after public issue, the promoters have unloaded their shares. Now the company is dependent on the management, and because of this, even retail shareholders also should demand accountability from the ZOMATO. Now it is not the ZOMATO alone. Most of our venture capital pumped internet stocks have been bleeding at the bourses, some losing 3/4 in value within months post IPO listings. Not only ZOMATO, many companies which gone to public issue in the last year or recently lost its value and leading huge loss to the investors or mutual funds. Post-COVID, Middle India is going out at least to the chai stall. Restaurants and delivery agents both feel alienated on account of heavy margins charged by ZOMATO, commissions or poor working conditions that may even lead to caps, legal challenges or parliamentary interference. But if the retail investor lose their share before their express delivery reaches home, then credibility of the entire ecosystem will get hurt. Now, venture funded companies with low founder ownership should be run and managed. That is the basic question, how the venture funded companies will be managed with low founder ownership. A loss-making venture buying another loss maker is tough to justify, even if one argues that Blinkit gives ZOMATO to hold in the cash bustling yet unproven quick commerce segment. Most are buying them with deep discounts. Many recently listed public issue companies, software companies, technology-based companies are being traded with deep discounts in the stock market. For a company yet to generate cash and that may have to soon tap the markets to raise finances, its founder has forgotten that Zomato post-listing is no longer his company but ours, a collective called shareholders. That is a lesson for all young tech titans. So after listing, the company becomes ownership based, the company becomes promoter based to collective called shareholders. That is a big lesson to all people, to all investors who invested in tech companies.